Hello. In this video, I'm going to discuss fiscal policy. So fiscal policy is the use of government spending and taxation to influence the economy. By influencing the economy, I mean how federal government can tackle the problems of unemployment and inflation using fiscal policy, that is, using government spending and taxation. The Minister of Finance presents an annual budget to Parliament each spring. The budget contains estimates of the government's revenues and expenditures for the coming year. The federal government's budget, that is government expenditures minus taxes or taxes minus government expenditures. Normally we write taxes minus government expenditures because we show budget deficit as a negative number. And this budget, government budget, that is taxes minus government expenditures. So let me write here. So this is basically T minus G. So this is basically T minus G, that is tax revenues or net tax revenues minus government expenditures. So the government's budget depends on the following three factors. That is rate of taxation. Of course, the government is receiving revenues in the form of taxes. The government budget deficit will decrease and surplus will increase, right? So government has more revenues. Size of the government, because taxes will depend on your income. And finally, the spending levels. If government spends less deficit, and if government spends more deficit. Okay, before going and before discussing the fiscal policy, the use of fiscal policy in three different schools of thought, let me quickly review what do we mean by a recessionary gap or an inflationary gap. So in a recessionary gap situation, that is when the economy is experiencing a recessionary gap, it means that the real GDP, and by real GDP, I mean equilibrium GDP, equilibrium real GDP is less than, or actual GDP is less than potential or full employment GDP. So if the economy is producing goods and services that is less than its full employment level of output, this is a recessionary gap situation, which simply means that the economy is facing high unemployment. So unemployment is always associated with a recessionary gap or the recessionary phase of the business cycle. Inflationary gap, in inflationary gap, when the actual real GDP or equilibrium real GDP is greater than full employment real GDP or potential real GDP, that is, the economy is producing more than full employment level of output, that is feasible. Why? Because full employment does not mean zero unemployment. Even at full employment, we do have frictional and structural unemployment. So if you somehow reduce frictional and structural unemployment, it is possible to produce more than full employment level of real GDP, but that will exert pressure on prices, and we do have inflation in such a situation. So as inflationary gap is of course associated with inflation. So during this phase of the business cycle, the economy is experiencing high inflation rate. Now let's talk about a little bit more about federal budget and national debt before uh, coming back to fiscal policy. So NTR, by NTR I mean net tax revenue, basically is tax revenue minus transfer payments. So if you subtract transfer payments from tax revenues, you get net tax revenue. Now for the simplicity, or just to make the analysis simple, instead of saying net tax revenue every time, I'm going to just say capital T. By capital T, I mean tax revenues, of course, net of transfer payments. So if you have net tax revenue and if you have capital G that represents government spending, we can explain budget surplus, budget deficit, and balanced budget. So by budget surplus, I mean when net tax revenues are greater than government is spending. Budget deficit means when net tax revenues are less than government expenditures, so you should have a negative number. And balanced budget means your revenues, means federal government revenues are exactly equal to its own expenditures. So balanced budget basically is the equality of net tax revenues and government spending on goods and services within a given time that is normally a year. Now, once we know budget deficit, budget surplus, then we can define national debt. So national debt is nothing but the summation or the addition or the sum of all federal government's annual budget deficits, and then we subtract all surpluses. So the number that we have is basically the accumulation of all deficits and net of surpluses. That is what we call national debt. So now these are the three schools of thought on fiscal policy. So let me read this out and then we'll discuss each of these three philosophies separately. The first one is what we call counter-cyclical fiscal policy. This group of economists believes that whenever a country is facing either a problem of unemployment or inflation, then federal government should do something through its own expenditures and taxation policy to solve the problem of unemployment and or the inflation. So when faced with the recession, by recession I mean if the economy is in the recessionary gap, the government should overspend, that is, increase its expenditures to solve the problem of unemployment. And of course, when government is spending money, it means government is running a deficit. And when faced with an inflationary boom, that is, inflationary gap, should underspend, that is, should reduce its expenditures. So we have surplus to help the economy achieve the goals of full employment and stable prices. So by counter-cyclical fiscal policy, I mean that government should intervene and correct the problem. And we have two problems, either unemployment or inflation. The second philosophy argues that the problem of unemployment and inflation is temporary, is only in the short run. And therefore, the market forces will automatically fix this problem through the adjustment in wages and prices. So the market will adjust itself. So government should not worry about these two problems. Government should worry about deficit or surplus. So this philosophy says that federal government should balance its budget every single year. That is, balancing the budget annually, remember, every year, is the prime aim of the fiscal policy. That is, if government is running a deficit, then the fiscal policy in this case should be to decrease government expenditures so that you can balance your budget or increase tax rates. In the first philosophy, you don't need to worry about deficit or surplus, just solve the problem of unemployment and inflation. So they are saying that don't worry about inflation and unemployment. They're not saying that unemployment, inflation, these two problems are good, but these problems will be automatically taken care of through market forces. The third philosophy is nothing but the amalgamation of the first two. According to this view, we should not balance our budget annually or every single year, but we should balance our budget over the period of the whole business cycle. So we'll discuss in a moment the third philosophy as well. So for example, if the economy is in the recessionary phase of the business cycle for 2 years, so we have unemployment for 2 years, so government should run a deficit, that's fine, but fix the problem of unemployment. And then the other 3 years, for example, if the duration of the business cycle is 5 years, so first 2 years we run a deficit, the later 3 years we run a surplus because we have inflationary gap situation. So government should decrease its expenditure to solve the problem of inflation and running a surplus. So overall, during the whole 5-year period, we have balanced budget. So rather than balancing the budget every single year, we can balance the budget for the whole time horizon, for whole business duration of the whole business cycle. And of course, the duration varies from country to country and from time to time as well. So now let's start with the first philosophy or the first view, that is counter-cyclical fiscal policy. So I've already read this, that what do we mean by fiscal policy? That is, federal government should run a deficit in order to solve the problem of unemployment and should run a surplus, budget surplus, and solve the problem of inflation. Let me show you this diagram. So I've drawn 3 lines basically. Aggregate demand is a downward sloping line, aggregate supply is an upward sloping line, and the potential GDP, a vertical line that shows full employment level of real GDP. If you notice, Y1 is the level of actual production in this economy. So right now, this country is producing at Y1. The full employment is YE. So the gap between YFE and Y1 is called a recessionary gap. That is, we have unemployment in this country. So this economy is facing the problem of unemployment. According to the counter-cyclical fiscal policy, the federal government should increase its expenditures or should decrease tax rates so that the aggregate demand in the country will increase or the aggregate demand curve will shift to the right. Let me show you that using this fiscal policy. So, I could have written a decrease in taxes as well. So I just wrote increase in government expenditures, but it doesn't make any difference. So you can see I just wrote increase in G. So dealing with the recessionary gap, the fiscal policy would be to increase government expenditures and or lower taxes. Total spending increases to 82, that is aggregate demand curves will shift rightward from 81 to 82 and shifts the economy back to its potential real GDP. So the problem of unemployment is solved, but with budget deficit, because we are assuming that if we are actually if we have a balanced budget during recessionary gap, then if you fix the recessionary gap or solve the problem of unemployment using fiscal policy, then government will run a budget deficit. This is called expansionary counter-cyclical fiscal policy. Why I am saying expansionary? Because the policy, the fiscal policy is used to expand the economy. We are expanding the economy. We are increasing the aggregate demand in the country so that aggregate demand increases. People demand more goods and services. So this is for the inflationary gap situation, that suppose the economy is experiencing high inflation rate, and you can see this diagram depicts inflationary gap. That is Y1, which is the actual real GDP, is more than full employment level of or potential real GDP. That is FE. FE is full employment equilibrium or full employment level of a real GDP. FE means full employment, basically, not equilibrium. So how to solve this problem? Using counter-cyclical fiscal policy. That is, in this case, we have to shift aggregate demand curve to the left. Why? We want to contract the economy because the economy is overheated. That is why inflation is taking place. That is, prices are soaring. So we have to reduce the demand. Exactly opposite what we did in a recessionary gap situation. So this is what we call contractionary counter-cyclical fiscal policy. That is, now we are reducing the aggregate demand. How? By reducing government expenditures and increasing taxes. So if you look at this diagram, what I have done, I just shifted the aggregate demand curve to the left. So the G is decreasing. This is a fiscal policy, or raise taxes, same thing, or both at the same time together. That will shift the aggregate demand to the left from 81 to 82. And you can see there is no inflationary gap. Why there's no inflationary gap? Because you can see that this is the equilibrium, and which is exactly equal to YFE. So there's no problem of inflation, but the federal government is running a budget surplus. Why? Because the policy is to reduce government spending. That will lead to budget surplus, because you are getting the same revenues, but you are spending less. It means you have surplus. So this is the first philosophy, that if you have two problems, inflation and unemployment, just use the government spending and taxes to fix these two problems. Of course, in the recessionary gap situation, you run a deficit. In an inflationary gap situation, you run a surplus. Now, the second view is that the problem of unemployment and inflation will short-lived situation, and will be solved in the long run. Let me put this way: automatically, by automatic I mean through market forces. There's no need for government intervention to fix these two problems. So here I already written here, the economy will eventually return to full employment through a self-adjustment process. So we don't need to, we means the federal government doesn't need to worry about unemployment and inflation, because it will be taken care of. The role of federal government is to balance its budget annually. So this view is based on what we call automatic stabilizer. Now, what is automatic stabilizer? By automatic stabilizer, I mean that when we have unemployment in the country, or when the economy is in the recessionary phase of the business cycle, or when we are experiencing a recessionary gap, they're all the same thing, right? Then government expenditures will increase. How? Not through fiscal policy, but it is automatic. Why? Because if we have high unemployment in the country, people will apply for welfare benefits, and therefore government will have to spend more to help those people. Similarly, if people are not working, if people are not working, they're unemployed, they're not going to pay taxes as well. So government revenues or tax revenues, to be more specific, will also decrease. So see, there's no fiscal policy, but the government is running a deficit. According to this view, government should balance its budget. That is, balancing the budget means, so if you are running a deficit and you want to balance your budget, then you have to reduce your expenditures or increase your revenues, or both at the same time. This is the only way to balance your budget. Let me show you this policy through using these two diagrams. So this is the same diagram that I had shown you earlier that depicts a recessionary gap situation. You can see that the economy is producing, that is Y1 actual real GDP, which is less than the full employment level of real GDP. It simply suggests that the economy is experiencing high unemployment in the country. Now, if you have high unemployment in the country through automatic stabilizer, we are running a deficit, right? That government spending is increasing, tax revenues are decreasing, not through fiscal policy automatically, right? To stabilize the economy. So, what is the policy option for the federal government? According to this view, government should not try to fix the problem of unemployment, or should not try to reduce the gap of this gap, but should balance its budget. How? So if you are running a deficit, then to balance the budget, the government should decrease its expenditures or increase taxes. What would happen if government decreases its expenditures? Aggregate demand curve shifts to the left further. Let me show you in the next diagram. So this is what is happening. So if you have recessionary gap, tax laws and spending programs that automatically increase spending during the recession, and then it means that the government is running a budget deficit. So BBFP, I mean balanced budget fiscal policy, it says that you have to balance the budget. So the government must decrease expenditures and or increase taxes. This will shift the aggregate demand curve leftward, creating more unemployment in the country. So basically, we are increasing the severity of unemployment in the country. We are basically increasing the already existing recessionary gap. And you can see we have now, the gap is more. Why? But the budget is balanced. Budget is balanced, but now we are facing a higher recessionary gap. That is why we call this policy a pro-cyclical. Remember, in the first view, we call it counter-cyclical. Counter-cyclical means if you are in the recessionary gap, then the policy will take you to the inflationary gap situation, that there's no recessionary gap. So we are it's counter-cyclical. So you are going against the cycle. Here, you are not going against the cycle. You are actually reinforcing the same cycle. So we are in the recessionary phase of the business cycle, and this policy will increase the severity so you go deep into the same cycle in the same direction. That is what we call pro-cyclical. Remember that in a recessionary gap situation, if you are running a budget deficit, then balanced budget fiscal policy is pro-cyclical. But suppose if you have the same recessionary gap situation, let me go back here. Suppose if you have the same recessionary gap situation, but instead of budget deficit, you have budget surplus. Suppose if you are facing high unemployment rate and the federal government is running a budget surplus, then balanced budget fiscal policy is exactly similar or identical to counter-cyclical fiscal policy. Because if you have surplus, in order to balance your budget, you have to increase government expenditures or decrease taxes. which is the same policy if you have a recessionary gap in countervailing or countercyclical fiscal policy. So if you do this, that is, if you increase government expenditures and decrease taxes, aggregate demand is that you can show will shift to the right. So when it will go towards right, towards in this direction, let me show you here. So if aggregate demand shifts in this direction, so you can see that the gap is also reducing. At the same time, you are balancing the budget. So balanced budget fiscal policy is pro-cyclical only in case of recessionary gap if you are running a deficit. And if you try to balance your budget, then the policy would be pro-cyclical. Pro-cyclical means it will increase the severity of this problem, that is unemployment. But normally we have budget deficit during recessions that I just discussed, automatic stabilizer, that is through spending on welfare programs and also lowering tax revenues because people are unemployed. Same analysis can be done for inflationary gap situation. Same idea, exact same idea. Let me show you this diagram. This is the inflationary gap diagram. And suppose we have budget surplus. Why do we have budget surplus? It is written here because the laws, the tax laws and spending programs that automatically decrease spending, because if people are working, if we have an inflationary gap situation, sorry, let me show you. So see here, we have inflationary gap situation. So we have overemployment. Overemployment means people are not applying for welfare programs, right? Welfare fundings. So government is not spending too much. Similarly, government is receiving higher tax revenues because everyone is working. So they are paying taxes. So we are running a surplus. So if we are running a surplus during inflationary gap, you know what would happen? If you have a surplus and you want to balance your budget, you have to increase government expenditures or decrease taxes because you are running a surplus. So for example, if you have a surplus income and you want to balance your budget, then either you spend more because you have excess, you have surplus, or you receive less. These are the two only ways to bring your surplus back to the zero surplus, right? That is balanced budget. So when you follow balanced budget fiscal policy in the case of inflationary gap, look at what is happening. Actually, you are shifting the aggregate demand further to the right. Why you are shifting further to the right? Because the government is increasing its expenditures. Why? In order to balance the budget. But while balancing the budget, you are increasing inflation in the country. You can see in the diagram, the new equilibrium point is at a higher price level. So if you see here, this is the new equilibrium point. This is the new equilibrium point. So you can see the price has gone up further. So basically you are increasing the already existing inflationary gap that you can see in the diagram here. So this is the increase in the inflationary gap. So it will increase the severity of inflation as well, this policy. And that is why we call this policy as pro-cyclical as well. This is pro-cyclical. Pro-cyclical means you are increasing the existing gap, not decreasing, but increasing the existing gap. Now, these are the shortcomings that I have already discussed earlier. In a recession, government spending is cut back. We know this because in recession, we have a budget deficit, increasing unemployment even more. In the boom, I mean inflationary gap, government spending increases, increasing demand and inflation even more. It is thus pro-cyclical. And I've already explained what do we mean by pro-cyclical. But just let me read this out as well. Tends to push the economy in the same direction as it is leaning in. So if you are in the recessionary gap, you will increase the recessionary gap further. That is the meaning of pro-cyclical. Increases unemployment and inflation severity. So you increase the unemployment, already existing unemployment, you have more unemployment if you want to balance your budget. And if you have inflation, then you'll increase inflation further to balance the budget. The third school of thought is basically the combination of these two. So by cyclically balanced budget fiscal policy, cyclically, not annually, balance the budget over the length of the business cycle. So just don't balance the budget every year annually. Balance the budget over the length of the business cycle. But so let me tell you what is this policy. So suppose if you are in a recessionary gap situation, don't try to fix or balance the budget. Just solve the problem of unemployment. And of course, when you're going and use the counter-cyclical fiscal policy, yes, you can solve the problem of unemployment, but federal government will run a deficit. That's fine. You are okay with deficit during the recession. But when you have in the inflationary situation, and if you use counter-cyclical fiscal policy, you are now generating more surplus because during inflationary gap, the counter-cyclical fiscal policy says that you means the federal government should decrease its expenditures. So basically, you are running a surplus. So you should run a surplus. So in recession, you run a deficit. In inflation, you run a surplus. And over the length of the whole business cycle, your budget is balanced, right? They cancel out each other. So this is what is written on this slide. Run a budget deficit to reduce unemployment using expansionary counter-cyclical fiscal policy during recessionary gap, and run a budget surplus to reduce inflation using contractionary counter-cyclical fiscal policy during inflationary gaps. But even we have a number of shortcomings as far as cyclically balanced budget fiscal policy is concerned. So no guarantee that the size and length of a recessionary gap will exactly offset the size and length of the inflationary gap. So suppose if you run $20 million during recessionary phase of the business cycle, and if you run $10 billion surplus during inflationary gap situation, then the net result is deficit, 20 deficit and 10 surplus. So still you are in deficit, 10 deficit over the length of the business cycle. So it's not always the case that you have exact same duration of these two cycles. That is one issue. The second issue is very important. Increasing government spending to balance the budget in bad times is politically easy. Decreasing government spending in good times is politically hard. Okay, so if you're already running a surplus, then people don't like federal government if they are going to reduce government spending, because people argue that if we are at if the economy is booming, why government, and government also has reserves and funds, why not government is spending money? Business cycle rarely match political cycles as well. So governments blame earlier governments for deficits. So if you follow the cyclically balanced budget fiscal policy, so during the during the whole length of the business cycle, you should have one government, because if you have a different government in different phases, there's a problem that the new government will always blame the previous government, that they actually created this deficit. That was because of their wrong policies. So we are trying to fix the errors that the previous government committed, and it's difficult to prove. So these are a few problems associated with cyclically balanced budget fiscal policy. Thank you.